You're listening to Earnings Unscripted, where we unpack what really happened in today's earnings without the corporate PR filter. Today's Thursday, February 5th, 2026, and we are looking at Roblox.
The quarter of contradictions.
You beat me to it. I was going to say the grown-up pivot, but yours is catchier. It looked like a chaotic afternoon for the stock ticker.
Chaotic is putting it mildly. Look, RBLX had been melting down all Q4 and nearly 40% coming into today. People were terrified. Then the print hits at 4 p.m. and it rockets from $60 to $77 in minutes.
That's a massive relief rally.
It was. But then the conference call started and reality set in. It faded pretty hard back to around 65 in the extended session. Classic buy the headline, sell the details.
Okay, so let's talk about that headline. On the surface, the money side looks fantastic, right?
On the money side, absolutely. Bookings hit $2.22 billion. That is up 16% from the third quarter. That is a massive sequential jump. Revenue was solid pew, $1.42 billion. So financially, the engine is roaring.
Right. 16% jump in bookings is huge. But I sense a but coming.
The but is the people, the actual players. Daily active users dropped, like significantly. We went from 152 million in Q3 down to 144 million this quarter.
Wait, users fell? During the holiday quarter? That's supposed to be prime video game season.
Right? And it wasn't just users. Hours engaged dropped 12.5%. That's 5 billion hours of gameplay just gone compared to the quarter prior.
Wow. So they made 16% more money while 5% of their audience walked out the door.
Which sounds like efficiency heaven if you're a CFO and an existential crisis if you're a product manager.
Efficiency heaven or the beginning of a churn spiral. We'll have to see. And just real quick, before we tear into the why behind that user drop, reminder to everyone listening, Miro and I are digging through data, not managing your portfolio. None of this is financial advice, just our personal take on the numbers. Don't sue the podcast.
Please don't. My legal budget is zero.
Exactly. Okay, back to the contradiction. So fewer people, way more spending. Is this just inflation or did the whales show up?
It's demographics. This is the fascinating part. Management claims that user drop is self-inflicted. They rolled out these mandatory age checks to clean up the platform. It caused what they called a mid-single-digit headwind. Basically, they added friction to the login and the low-intent users bounced.
Ah, the bouncers at the door strategy. Keep the riffraff out, keep the heavy spenders in.
Precisely. And the spenders who stayed, they are older. They dropped a data point that honestly saved the narrative for me. The 18 to 34-year-old cohort, they monetize 40% higher than the kids.
That makes sense. I mean, an 8-year-old has to beg mom for $5. A 25-year-old just scans their face and the credit card clears.
Exactly. So in a way, Roblox is trading volume for value. They lost 8 million daily users, but the ones that stayed are worth a lot more. That drove free cash flow to $307 million, up huge year over year.
It sounds smart on paper. Pivot to the adults, let the free-to-play kids drift away, but isn't being where the kids are literally the entire moat of this company? If you stop being the digital playground, don't you lose the next generation of whales?
That is the billion-dollar question. And looking at their expenses, especially how much stock they're issuing to keep engineers happy, I'm not sure they figured out how to grow both groups at once yet.
Yeah, let's pull on that thread because there was something else buried in the back of the report about guidance going away.
Oh yeah, the trust us, we know what we're doing clause. Let's get into the details because that plus the AI spend is where the real story is.
Yeah, that guidance piece feels like the headline that got buried. Usually when a management team says, we're going to stop telling you what to expect for the full year, it means they don't know what to expect.
Or they know and they don't like the variance. Explicitly, they said starting in 2027, annual guidance is gone. The quote from the 8K was basically that it's no longer a helpful tool given the unpredictability of viral growth.
Unpredictability of viral growth? That sounds remarkably honest for a public filing.
It is. And look, they're right. But it signals a massive shift in how they want Wall Street to value them. They are effectively saying, stop treating us like a SaaS company with predictable subscription revenue. We are a hit-driven entertainment studio now. If a game like, Steal a Brain Rot goes viral, bookings explode. If nothing hits, you get Q4's user drop.
But wait, if they're pivoting to be hit-driven, isn't that way riskier? I thought the whole point of the metaverse was that it's a platform, a utility, safe, steady, sticky.
That was the pitch, but that pitch hit a wall with kids. They saturated the playground. Now, to grow, they need the 20-somethings playing shooters and racing games. In the report, they specifically called out expanding into novel genres to target that 18 to 34 demographic.
Novel genres, like literary fiction?
No, I think novel is just corporate speak for games that don't look like Lego blocks. They're talking about high-fidelity shooters, RPGs, stuff that competes with Call of Duty or Fortnite. And to build that, they need this new generative AI tech. They mentioned adding a fourth dimension to objects. Interactivity.
Okay, hang on. A fourth dimension? Please tell me we're not doing time travel physics.
No, it's actually really clever tech. Basically, traditionally, you build a 3D chair asset, it sits there, it does nothing. With their new AI cube model, that chair knows it can be sat on, broken, or thrown. It has functional logic embedded. That creates massive leverage for developers. You can build a novel, complex game in a fraction of the time. But technology isn't free.
And here comes the ledger check, because their trust and safety spend was, $200 million this quarter?
$209 million, yes. Plus, infrastructure costs are ramping for AI workloads. But, Susie, the number that really bothered me wasn't the cash going out. It was the dilution coming in.
Oh, stock-based comp. I saw that figure.
It's stark. Stock-based compensation was $298 million this quarter. Free cash flow was $307 million. Basically, for every dollar of cash they generated for the business, they printed a dollar's worth of stock to pay employees.
Wow. So if you net those out, the shareholder is effectively flat?
Right. You are funding the cash flow neutrality via dilution. It's not sustainable if the stock price drops, because then you have to issue more shares to pay the same dollar value salary. That's the death spiral risk.
Which brings us back to the guidance cut. They're asking investors to accept massive volatility and steady dilution in exchange for a hope that they can build Call of Duty on a platform designed for Adopt Me?
A bit harsh, but not inaccurate. And remember, the CEO got on the call and said they have more conviction than ever in growing 20+%. Confidence is high, visibility is low. That is a spicy combination.
Spicy is one word for it. So where does this leave them heading into next quarter? Are we just waiting to see if the adults actually stick around?
I think waiting implies we are passive observers. But honestly, next quarter is an audit. If the adults don't stick around and that engagement drop wasn't just friction from the age checks, then the math breaks.
Right, because you can only optimize your existing user base so much. Eventually, you need bodies in the room.
Exactly. Management says the age check rollout was a temporary speed bump, a mid-single-digit hit. So logically, Q1 must show a rebound in hours played. If we see another decline, then it wasn't friction, it was saturation.
It feels like the company is going through its own awkward teenage phase, doesn't it? They're trying to gentrify the metaverse, kick out the noisy kids who don't pay, and renovate the place for the 20-somethings with disposable income.
Gentrifying the metaverse. That's actually a perfect description. And look, gentrification usually drives property values up. The problem is the renovation costs. Despite that record bookings number, the consolidated net loss actually widened to $318 million.
Yeah, growing broke is one thing. Growing richer while staying broke is a harder sell.
Precisely. They are scaling revenue, but they are scaling AI infrastructure and safety costs just as fast. It's like running on a treadmill that speeds up every time you take a step.
So looking ahead, the vibe I'm getting is high risk, high reward. They're asking us to trust them on this novel game strategy, trust that the user dip is temporary, and trust them without a guidance map starting in 2027?
It is a black box investment now. You either believe Dave Baszucki can build a super intelligence-powered gaming empire, or you worry they're burning cash to build a walled garden nobody wants to pay to enter.
Well, one thing's for sure, it won't be boring.
With this volatility, boring would be a luxury.
On that note, we're going to wrap it up there. You've been listening to Earnings Unscripted, and just so we're transparent, this episode was researched, written, and performed with the help of AI tools.
Which hopefully hallucinates less than the market did this afternoon.
We try our best. Thanks for listening, and we'll catch you on the next print.
Before you go, I want to take a quick second to explain what Earnings Unscripted actually is, because it's a little different from the other shows in your feed. This project is an experiment by a small team of enthusiasts exploring the edge of what generative AI can do. This entire episode, from the initial deep dive research into the SEC filings to the script writing, fact-checking, and the voices you're hearing right now, was created by a chain of specialized AI agents working together. It is our attempt to see if technology can do more than just summarize data. We want to see if it can be witty, skeptical, and honestly helpful in a way that creates high-quality information you actually want to listen to. We are learning as we go, so if you have questions, feedback, or you just want to say hello to the ghosts in the machine, please reach out. You can email us at earningsunscripted@datamadness.ca or find us on X.
See you after the next call.